Welcome back. Today, we are getting our hands dirty. We're not just going to talk about investing, we are going to build an actual blueprint for a seriously powerful investment portfolio, right from the ground up.
So let me ask you something. When you picture a successful investor, what pops into your head? Is it some high-flying stock picker you see in the movies? A risky trader making all-or-nothing bets? Well, the truth is, for most people, the real answer is something completely different. And you know what? It's actually much more achievable.
Yeah, the myth is this idea of the lone wolf making an absolute killing on one single hot stock. But the reality? For the vast majority of millionaires, wealth is built slowly, steadily, and kind of boringly. The two biggest sources of their wealth are usually their home and their long-term retirement accounts. That means the real success story is the person who has a solid, stable investment portfolio.
And that, right there, brings us to the big idea for today. Let's just stop thinking of a portfolio as this random shoebox full of funds and stocks. Let's start seeing it for what it truly can be, a powerful, well-engineered machine designed for one specific purpose, creating wealth. And lucky for you, today we've got the blueprint to build it.
All right, let's get into it. Here's the 5-step blueprint we're going to walk through to build this wealth engine. We'll kick things off with the foundation, your goals. Then we'll talk about the fuel, build the chassis, install the navigation system, and finally, figure out the accelerator and the brakes. So step 1, defining your goals. I know, it sounds super simple, but this is the critical foundation that, honestly, so many people just skip right over. And without knowing what you're building for, the whole structure is just, well, it's unstable from the start.
And this table just brilliantly illustrates why this is so important. Look, different goals need completely different strategies. Money for an emergency? That needs a preservation strategy. It has to be safe, period. Generating monthly income? That's a cash flow game. But saving for retirement, which is decades away, that demands a growth strategy, and that means you need to take on some calculated risk.
Now here's where it gets really interesting, the real-world impact. The source material gives this perfect example of someone who had the retirement money in a safe, government-backed savings plan, earning around 7.7%. But once they realized their goal was actually long-term growth, they shifted that money into an equity ETF. Their potential return jumped to 13.6%. That 5.9% difference every single year. That's the massive power of getting this first step right.
Okay, let's move on to step 2, figuring out your ideal asset mix. So if your goals are the foundation, then your asset allocation, the mix of stocks, bonds, gold, all that stuff, that's the fuel that's going to power this wealth engine of yours. But here's the crucial point. This isn't just about chasing the highest possible number. The real goal is to get the best risk-adjusted return. What does that mean? It means you're either getting more return for the same amount of risk, or, and this is key, you're getting the same return but with way less volatility. It's about making the ride smoother and a whole lot more efficient.
Now, I'm sure you've probably heard this old rule of thumb. Take 100, subtract your age, and boom, that's the percentage you should have in stocks. It's simple, I'll give it that. But for a lot of people, especially if you have a larger portfolio, it can be incredibly inefficient. I mean, check this out. Let's take a 50-year-old with a pretty substantial 20 crore portfolio. The old rule says they need 50% in equity and 50% in safer debt. That means a massive 10 crore rupees is just sitting in lower return assets. Is that really necessary for safety? For most people, probably not.
And here is the much smarter alternative. Instead of a rigid percentage, decide on a fixed amount you need for your safety cushion. Maybe for this person, 3 crores is more than enough to sleep well at night. Now look what happens. The remaining 17 crores, a whopping 85% of the portfolio, is freed up to be put to work in higher growth assets.
So the big takeaway here is that the safety cushion approach asks you to define a number, not a percentage. Figure out the absolute amount of money that makes you feel totally secure, lock that away in safe stuff, and then let the rest of your portfolio go out and work as hard as it possibly can for you.
Okay, on to step 3. Let's talk about structuring the portfolio itself. This is like building the chassis of our engine. It's the framework that's going to hold everything together in a really logical and robust way. And a fantastic way to do this is with what's called the core satellite model. So about 80% of your portfolio forms the core. Think of these as your foundational, stable, broad-based investments, like simple index funds.
Then the other 20% is your satellite. And this is where you can get a little more adventurous with targeted investments in specific sectors or themes to try and capture some extra growth.
All right, so we've got a structure, but now you're thinking, okay, but there are thousands of funds and ETFs out there. How do I even begin to choose? Step 4 is all about creating a navigation system to make that selection process clear and systematic, not just a random shot in the dark.
Instead of just chasing whatever fund did well last year, we can use a mental map, like this 3x3 grid. It's super simple. On one axis, you've got company size, large, mid, and small cap. On the other, you've got the investment style, growth for fast-growing companies, value for ones that seem underpriced, and momentum for stocks that are already trending up. This simple grid helps organize the entire universe of choices.
And here's where it gets really practical. We can start populating this grid with actual real-world ETFs. You can find a large-cap momentum ETF, a value ETF, various growth funds, and suddenly your selection process isn't about picking a random name from a list. It's about filling a specific role within your predefined structure. It literally turns chaos into clarity. Okay, this brings us to our final step, creating a smart system for entry and exit. We've built the engine, now we need the controls. Think of this as the accelerator and the brakes. It's all about knowing when to put more money to work and when it might be a good idea to take some profits off the table.
The key here is to pay attention to market valuations. This table, based on historical data, shows a really clear link between the Nifty's price-to-earnings ratio and the average returns you can expect over the next 5 years. The pattern is obvious, right? When valuations are attractive and cheap, future returns tend to be high. When they're expensive, well, future returns are much, much lower.
And this data lets us create a simple, repeatable system that takes emotion out of the equation. So your default mode should always be systematic investing, like an SIP, just investing a fixed amount regularly. Then you can be opportunistic, adding extra lump sums when valuations look good, and you can be strategic, taking a little bit of profit when valuations start to look really high.
So let's do a super quick recap of the entire blueprint. First, define your goals to set your strategy. Second, use a safety cushion instead of some rigid old rule. Third, build your chassis with a core satellite approach. Fourth, use that 3x3 grid to select your investment systematically. And fifth, time your entries and exits based on market valuations, not your gut feeling.
You know, the single biggest takeaway from all of this is that having a structured, deliberate process is what truly separates successful long-term investors from short-term speculators. It's what transforms investing from a gamble based on emotion into a well-engineered, long-term plan for success.
And that leaves us with one final question for you to think about. When you look at your own investments, do you see a coherent machine built from a clear blueprint, or do you just see a random collection of spare parts you've picked up along the way?